There is always a moment before the market reveals its hand. It does not announce itself with noise. It does not ring a bell. It simply tightens. Price compresses. Volume contracts. Volatility dries up. To the untrained eye, nothing is happening. But to the disciplined speculator, everything is happening. Jesse Livermore built his fortune not on prediction, but on preparation for this moment. He understood that markets move in cycles of accumulation and expansion. Before every great advance, there is a quiet test of patience. Most traders fail here. They confuse movement with opportunity. They believe activity equals profit. When price begins to twitch, they interpret it as a signal. When the crowd grows excited, they interpret it as confirmation. They enter early. They enter emotionally. And when the market pulls back, as it often does, they are shaken out. Before the real move even begins, Livermore saw this pattern repeat for decades. The desire for constant action, irrespective of underlying conditions, he once observed, is responsible for many losses in Wall Street. He knew that the real opportunity did not lie in the first flicker of motion. It lay in the structured emergence of strength. The first step of his entry philosophy was not technical. It was psychological. He trained himself to do nothing until the market proved itself worthy of participation. This is the paradox. The best entry often feels uncomfortable because it requires waiting longer than the crowd can tolerate. The market tempts you with early movement. A breakout appears to be forming. Social chatter intensifies. Analysts speak with confidence. And yet Livermore would still wait. Why? Because he understood something deeper than chart patterns. He understood human nature. Crowds anticipate. Professionals confirm. In the early stages of a potential move, price will often probe resistance. It may even briefly break above it. But without follow-through, without conviction, the move collapses. These are false dawns, and they are expensive lessons. Livermore refused to pay for anticipation. Instead, he studied what he called the line of least resistance. This was not merely a trend line on a chart. It was the path where pressure had the greatest probability of continuing. If a stock had been rising steadily, forming higher lows, respecting support levels, and expanding on strength, that was a clue. It suggested that accumulation had taken place quietly beneath the surface. But even then, he did not rush. He waited for confirmation, a decisive breakout from a well-formed base, accompanied by increasing activity. He wanted proof that the imbalance between supply and demand had tipped because, in his mind, an entry was not a prediction of what might happen. It was a reaction to what had already begun. This distinction separates speculation from gambling. A gambler bets on possibility. A speculator aligns with probability. Livermore's early years were filled with painful lessons. As a young trader in bucket shops, he learned to read price movements with precision. But even then, impatience cost him. He would see a setup forming and enter before the full signal emerged. Sometimes he was right. Often he was early. And being early in markets can feel identical to being wrong. Over time, he refined his discipline. He realized that missing the first few points of a move was not a tragedy. Entering prematurely was. The market does not beat them, he wrote of reckless traders. They beat themselves. The moment before the move is a test. A test of ego. A test of patience. A test of whether you trust your system more than your impulses. When price tightens and the range narrows, tension builds. This compression is not boredom. It is energy gathering. But energy alone is not enough. It must be released with authority. Livermore's first unwritten rule was simple. Do not act until the market speaks clearly. Clarity to him meant structure. A defined resistance level. A recognizable pattern of higher lows. A contraction in volatility followed by expansion. And most importantly, behavior consistent with strength. He did not try to outsmart the market. He allowed it to declare its intention. This is where most modern traders still fail. They scroll through charts. Searching for excitement, they interpret every candle as meaningful. They fear missing out more than they fear losing money. And so they enter too soon. But the disciplined operator waits for alignment, trend, structure, Confirmation only when these elements converged would Livermore prepare to act. Not emotionally, not impulsively, but methodically, because he knew the entry was not just about getting into a position, it was about entering at a point where the market itself was carrying the risk. And when that moment finally arrived, when price broke decisively, when volume expanded, when the line of least resistance was undeniable, he did not hesitate, he acted, not because he felt certain, but because the conditions justified commitment. That is the moment before the move, and that is where real speculation begins. If Section 1 was about patience, Section 2 is about control, because even when the market aligns, even when structure forms and confirmation appears, the greatest danger is still not volatility. It is you. Jesse Livermore did not design his entry formula merely to identify opportunity. He designed it to filter emotion. Every step of his method was a barrier between impulse and execution. He understood that the market does not deceive traders. Traders deceive themselves. The first psychological enemy is anticipation. Anticipation feels intelligent. It feels proactive. It whispers, if you see it forming, why wait? But anticipation is ego disguised as foresight. It assumes you can outpace the market. Livermore learned the hard way that premature action drains capital faster than ignorance. He wrote, "A man must believe in himself and his judgment if he expects to make a living at this game. That is why I do not believe in tips. Tips are anticipation outsourced, and anticipation is risk without confirmation." So his first filter was alignment with the dominant trend, what he called the line of least resistance. If the general market was weak, he did not look aggressively for long entries. If a stock was in a clear downtrend, he did not attempt heroic bottom fishing. He aligned himself with prevailing pressure. Why? Because fighting the primary trend is an emotional decision, not a strategic one. The crowd loves reversals. They offer the illusion of brilliance. Buying the exact bottom or shorting the exact top feels like genius. But Livermore was not interested in applause. He was interested in probability. His second filter was structural confirmation. He waited for price to prove strength by breaking out of a defined range, not drifting above it, not poking through it, breaking it decisively. This distinction is subtle but critical. A weak breakout hesitates. A strong breakout expands. Livermore demanded expansion. He wanted to see evidence that demand was overwhelming supply. Without that imbalance, he did nothing. Then came the third filter, the probing entry. This is where his genius becomes mechanical. Instead of committing full capital at once, he entered small. A test position, a probe. If the market moved in his favor immediately, that was information. It confirmed that he was aligned with momentum. If it moved against him, he exited quickly with minimal damage. He did not argue with price. The market is never wrong, he said. Opinions often are. This philosophy eliminated emotional attachment. He was not trying to prove he was right. He was testing whether the market agreed. Modern traders struggle here. They enter full size because conviction feels powerful. They average down when price moves against them because hope feels rational. They widen stop losses because admitting error feels painful. Livermore did the opposite. He started small. He added only to success. He cut losses without debate. This brings us to the fourth psychological barrier, scaling only into profit. Most traders increase exposure when they are losing, believing lower prices offer better value. Livermore considered this dangerous thinking. If the market disagreed with his initial position, he reduced risk. If the market agreed, he increased it. He pyramided into strength. Each addition was smaller than the total position, but larger than the initial probe. It was structured growth, not reckless expansion. The market had to earn his confidence. This approach transformed entry. From a single event into a process, entry was not a moment. It was a sequence of confirmations. And the final filter was emotional neutrality. He refused to enter because of excitement. He refused to enter because of fear of missing out. If he missed a move entirely, he accepted it. There would always be another. The game taught me the game. He reflected. The lesson was simple. Survival precedes success by building multiple layers of confirmation into his entry formula. Livermore removed urgency. Urgency is the enemy of discipline. When a trader feels rushed, clarity disappears. His system forced patience, trend alignment, structural breakout, immediate follow-through, small probe, add only if profitable. 5 steps, 5 barriers against self-sabotage. But beneath these mechanics was a deeper truth. Livermore did not trust his emotions. He trusted process. He knew that fear would tell him to hesitate at the right moment. He knew that greed would tell him to overcommit. He knew that ego would whisper that he was smarter than the tape, so he built a framework that required the market to validate him before he committed meaningful capital. This is why his entries were rarely spectacular in timing, but often spectacular in outcome. He did not aim to catch the first tick of a move. He aimed to catch the heart of it, and once inside, with confirmation behind him and risk controlled, he could do what most traders cannot. He could sit, because the hardest part of speculation is not entering. It is entering correctly, so that patience becomes possible when the entry is wrong. Anxiety dominates. When the entry is aligned, conviction becomes quiet. That quiet conviction was not confidence in himself. It was confidence in the process he refused to ignore. A century has passed since Jesse Livermore first stood on the floor of the exchange, reading the tape with relentless focus. The tools have changed. Screens have replaced chalkboards. Algorithms execute in milliseconds. Information floods the market without pause. But one thing has not changed. Human behavior. Fear still accelerates selling. Greed still fuels buying. Impatience still destroys discipline. And that is why Livermore's 5-step entry formula remains timeless. Markets evolve technologically, but psychologically they remain ancient. The same emotional cycle repeats in stocks, in commodities, in crypto, in forex. Excitement builds. Crowds rush in. Price overshoots. Weak hands panic. Strong hands accumulate quietly. Then the real move begins, often after the majority has already been shaken out. Livermore's genius was not in predicting the future. It was in understanding this cycle. He positioned himself where probability and psychology intersected in today's markets. Traders face even greater temptation. Social media amplifies noise. Financial headlines dramatize every fluctuation. Influencers declare new bull markets weekly. The pressure to act is constant, but the formula remains unchanged. Step 1. Align with the dominant trend. In modern markets, this means respecting higher timeframes. If the broader market is trending upward, the path of least resistance remains higher. Fighting that tide is still expensive. If the market is under distribution, optimism becomes dangerous. Livermore never traded against the prevailing current without overwhelming evidence. That discipline applies today more than ever. Step 2. Wait for structural confirmation. Breakouts still fail. False moves still trap traders. Liquidity hunts still occur. But decisive expansion supported by conviction and participation remains powerful. The names of the stocks change. The patterns remain. Step 3. Use the probing entry. This may be the most underappreciated element in modern trading. Too many traders treat entry as a declaration. Livermore treated it as a question. Is the market ready to move? He would risk a small portion of capital to find out. If the answer was no, the loss was minimal. If the answer was yes, the opportunity expanded. This approach protects both capital and psychology. When risk is controlled from the beginning, fear diminishes. When fear diminishes, clarity increases. And when clarity increases, discipline becomes sustainable. Step 4. Add only to strength. In today's environment, averaging down is marketed as strategy. Buying dips without confirmation is celebrated. But Livermore warned repeatedly against adding to losing positions. Never average losses, he said. Let the market prove you right. This principle alone separates professionals from amateurs. Adding to strength compounds probability. Adding to weakness compounds hope. and hope is not a strategy. Step 5. Let structure determine conviction. Once positioned correctly, Livermore's greatest skill was patience. He understood that true profits come from sustained trends, not constant trading. In modern markets, where intraday volatility seduces traders into overactivity, this lesson is even more relevant. The real wealth in speculation does not come from frequent entries. It comes from meaningful ones. There is a deeper reason. This formula still works. It forces the trader to respect uncertainty. No step assumes certainty. Each step demands validation. The trend must exist. The breakout must confirm. The probe must succeed. The additions must be earned. This layered confirmation builds resilience. When traders abandon structure, they become reactive. When they become reactive, they surrender control. And when control is lost, emotion takes command. Livermore's formula is not merely about entry. It is about emotional governance. It creates distance between impulse and action. It demands evidence before exposure. It reduces ego from decision-making. That is why it survives across generations. In crypto markets, the same principle applies. When a digital asset consolidates for months and then breaks out with expanding volume and sustained follow-through, the structure mirrors the setups Livermore once traded in railroads and industrials. On equity markets, leadership still rotates. True leaders still separate from weak names. Strong stocks still show relative strength before major advances. The patterns repeat because human reactions repeat. Livermore once endured devastating losses, not because his system failed, but because he violated it. Each downfall traced back to impatience, overconfidence, or deviation from discipline. His success, however, was rooted in unwavering adherence to structure. The 5-step entry formula is not glamorous. It will not place you at the exact bottom. It will not catch every move. It will not satisfy the ego's desire for perfection. What it will do is align you with momentum when probability is highest and risk is controlled, and that is enough. Because speculation is not about brilliance, it is about survival, positioning, and patience. If there is one lesson to carry forward, it is this: do not enter because you feel ready, enter because the market has proven ready. That was Livermore's secret, and in a world obsessed with speed, it remains quietly undefeated.